Okay, folks. Reminder, if you need one, since I've been nagging you about it all through the week, that your first quiz is day after tomorrow. Let me clarify the details. It'll be in the first 30 minutes. No, I was looking at yours, trying to figure out where the bell is coming from. Oh, okay, never mind. So the first 30 minutes of class, 3:30 to 4. So please, please, please don't be late. Because you could wipe out half the time of the quiz if you're coming at 3:45. 3:30 to 4. Right after class today, I will send you another email. I know you've been getting email after email. You blocked me, I don't care. But this email unblocked me and read it. Telling you there are about 100 of you from this class. Obviously, if all of you are in this class doing the quiz, it's going to be a nightmare. There's not enough space. So I'm going to remove 100 of you from this room and make you take the quiz in CAMEC 170. You know what that room is? Yeah, it's a bigger classroom that you get right. So it's close to this room. You walk upstairs, you walk across into the other building, CAMEC 170. So I'll tell you what. Mic's on.
No, I mean like the mics, like it's like a special classroom.
Yeah, it's
like the US.
Okay. It fits 130 people. So I'm going to move 100 of you. Please follow the alphabetical list that I say, because otherwise you'll end up with too many people in one room and not enough in the other. So go to the room you've been assigned on Wednesday from 3:30 to 4. And after the quiz is done, and this is important, there will be class. So don't wander away. It's not the end of the class. Come back to class for 30 minutes. Open book, open notes, obviously open calculators, whatever you want to bring. So the numbers are straightforward enough that you probably don't even need a calculator, to be quite honest. You could do it in your head. It's really about whether you can apply the concepts. If your lecture notes are on an iPad or even on your laptop, you're allowed to keep it open so you can see your slides, because obviously if you didn't print it off, that's where it's going to be. So 30 minutes, you won't have too much time to refer to stuff. That's my suggestion. Don't say, look, it's open book, open notes. I'll look it up once I get there. It's not going to work well for you. So, come prepared, use the notes if you need to, but if you're constantly looking at your notes, you're going to run out of time. I did give the quiz to the TAs, and because the rule I have is if I take whatever time it takes them and double it and see if you can get it. It is clearly doable, but it does require that you be comfortable enough with the material that you can do the prompts. Okay. It is, and I grade all the quizzes, so the TAs don't grade them. And I'm looking for ways to give you points, not take points away from you. So give me a chance to give you points. You know what I mean by that? If you just put the answer down with no work and it's wrong, it's 0 or whatever it is, show me your work before you get to the end. So if you've been right 90% of the way, I want to give you the points for being 90% of the way right. So it's not, all or nothing. It's not multiple choice. It's basically working through the problems and seeing if you can work through it. Question?
So looking at I was looking at the weekly challenges, and there for weekly challenge 3, for example, you have the best, worst, and then better.
Yeah.
So there's 3. What kind of are you the best in that case was you would have to use Excel and go that's not practical in that case.
Now,
But
I will recognize that you have 30 minutes. You don't have a laptop with Excel. So when I ask you to do things, I will factor that in. So one of the weekly challenges, you have to do this iteration on Excel. There's no way you can do an iteration sitting there with a calculator. So in a case like that, I will give you the cost of that comes out of the iteration. So I will save you the mechanical or the computational issues so that you're not working through what you need. So, I mean, I understand there's a time limit. You don't have Excel, so I cannot ask you prompts. That's why I said, be careful what you wish for. People ask, why don't you let us use Excel? Because then I would write a very different kind of quiz, and you don't want to see that quiz. So from that perspective, as I said, the quiz has been tested out. It's doable in well below the time I'm giving. It took the 2 TAs 16 to 18 minutes to do the quiz. You can add another 10 minutes because obviously you have more to catch up on. So it is clearly doable. It's not one of those quizzes where you got to put your pencil down and write. So the one thing I don't want you to do is as soon as you get the quiz, start writing, right? Because you're saying, I'm running out of time. Read the problem first. Make sure you look at what I'm asking for, because you might be answering things I don't even want you to answer. So make sure you get the question read before you start it. There's plenty of time. Don't panic, and don't leave problems untouched. For a simple reason. It's all about partial credit. I cannot give you any credit if you have no work shown at all. So try to spread your time. So do some time management. 30 minutes is, if you panic, can very quickly pass by. I went in the master sheet and I noticed that many of you haven't entered your company name yet. I know you picked a company. I trust you picked a company. I'm not even asking you whether you picked a company. Just enter the company's name in that spreadsheet. I just want to get a sense for who you value. Now, people often ask, what's the most exciting part about teaching evaluation class? And I'm going to use the word exciting as almost a curse word, is everything changes all the time. When we talked about country risk, you don't need any abstract discussion of country risk to understand what country risk is. It's the start of the class. What is your name again? He's doing a Kazakh company. And how much is your stock price down? 60%. Okay. So you pick so you will be hit by country risk whether you like it or not. This is not an abstraction. So we will get real world examples of everything in this class hitting you. So it's not a question of, it's not for discussion. It's actually something you have to think about in investing. So let's pick up where we left off on Wednesday. And before we do that, I want to start with my usual start of the class test. We talked about, I think we left the class off with money losing companies, right? And we talked about how different kinds of companies, the losses can come from different reasons. So one of the things that analysts often do when they look at money losing companies is to do what's called normalizing earnings. Sounds fancy because you think they're doing some kind of real analytical stuff, but normalizing basically means taking the last 5 years of earnings and just averaging them out. So here's a question I have. What type of money losing company is this approach to normalization going to give you a pretty reasonable starting point? I'll go through the choices. First is if, that the loss was unusual and you expect it to go away, right? That the problems that caused the loss were temporary and have largely been resolved. The business has not changed in fundamental ways. The company has not scaled up or down. You know what I mean by scaled up or down? That it's not doubled in size or halved in size. So you're taking average earnings over the last 5 years, which of those assumptions am I making?
I'm gonna go guess with
Okay, so it has to be D, and tell me why.
why? Because like just averages, like if the earnings change and you take the average of it, then what you're gonna reflect is not the loss, but the change.
You're going
in the
to,
size.
because you're using an absolute number when your company might have doubled or tripled in size, right? Your average. So one way to, so if that were the reason, you can use an average margin or an average percentage number. So the first three, so clearly D is right. But in a sense, I'm assuming lots of different things, right? When I normalize, what am I assuming? I'm going to revert back to the way things used to be, that whatever losses there were will go away, that things are going to go back. So in fact, I would argue that every one of those assumptions implicitly is in my head when I normalize things, which means lots of things can go wrong. I've seen people normalize earnings by using the last 5 years and end up losing their shirts because the company itself has shifted so dramatically that normalizing earnings is not going to give them a reasonable answer. Yeah.
If the loss was like super unusual, like just some lawsuit that you never think is gonna happen again, wouldn't it, instead of like taking the average, wouldn't it just be better to subtract out the loss?
You
And
could.
take the average.
Nothing is ever completely unusual, right? So if you have a strike every 30 years, you might not see it in the last 10. But if something is truly unusual, some kind of regulatory charge that's never going to come back, you might as well ignore it. Right? But my point is, when you normalize things, you are making these implicit assumptions, might as well make them explicit and ask yourself, am I comfortable with those assumptions? Second thing, and this is something we're going to talk about today. We've talked about cash flows, right? We've started with earnings. Today, we're going to get to free cash flow to the firm, which is a pre-debt cash flow. We're also going to talk about going from free cash flow to the firm to free cash flow to equity, which is cash that is available to pay out as dividends. Now, when you do this for some companies, especially young money losing companies, you're going to end up with negative free cash flows to equity upfront. So if you look at young growth company, you can have negative, not because it's a bad company, but because you're growing, you're not making much money, you're reinvesting huge amounts. You get negative free cash flows to equity, negative free cash flows to equity, negative free. Let's say this is true for the next 5 years. When you discount those negative free cash flows to equity back to get the value of equity today, what are you assuming? So when you see the negative free cash flow to equity in a spreadsheet, what are you implicitly assuming your company is going to be able to do? Minus $1 billion free cash flow to equity in year one. And I do this DCF valuation. What am I implicitly assuming that my company is going to be able to do in year one? Okay.
You're gonna make $1 million.
You can't make, in fact, I'm telling you, they're going to lose $1 billion, right?
You're gonna have to like.
You're going to have to raise fresh equity of $1 billion. That's what a negative free cash flow to equity means, that you're going to have to go out and raise equity. What does that mean? Issuing new shares, getting new venture capital money. It's called cash burn precisely for that reason. The reason venture capitalists don't like negative free cash flow to equity is it means that you have to go out and raise fresh venture capital, which is going to dilute the holdings they have as existing investors. Is there, so when I have negative free cash flow to equity for the next 5 years, and I keep assuming you can raise equity, is that a safe assumption that you're going to be always able to raise enough equity to cover your cash flow needs? So if I have a minus billion, minus a billion, minus a billion for the next 5 years, is it safe to assume that I can raise $1 billion? Why not? Why is it not safe to assume that I can raise $1 billion? Well, it's for the next 5 years, at least for the next 5. In fact, but back up. When we talk about venture capital, right now, a lot of people assume you can raise $1 billion. Why? Because we're in good times. That could very quickly change. In good times, you're able to raise capital because there are risk capital out to pay. Venture capitalists are willing to invest money. But people forget that venture capital is a boom or bust business. You know, in 2009, there was almost no venture capital invested in the US. People just held back. They said, we're not investing. They were terrified. Didn't happen during COVID, but so one of the things you have to worry about, and I will talk about this when we value young growth companies, is what if the market turns bad? What if we're not able to raise, because the reason you worry about that is in a discounted cash flow valuation, you assume you make it through the negative free cash flow years to make positive cash flows in this big terminal value. But if you're unable to raise the capital to sustain that negative free cash flow to equity, what happens to you as a company? What happens to many young companies? They run out of cash and they're not able to raise fresh capital. The game is over. You got to sell the business, you got to liquidate it. It's something we've got to think about more seriously with evaluating companies is what is the chance my company will not make? So to do all of that, though, we have to compute free cash flow as equity and free cash flow of the firm. So let's go back to where I left you in the notes. Which I think was slide 144, I think. So I left you with this page. Let's talk about. So if I were to frame where we are in the class, we've talked about how to get operating income. We want to update the number. We're going to clean up for accountants, clean up for one-time charges. We've got to, so let's say you got an operating income you're comfortable with. Then we said we have to pick a tax rate. You remember what our discussion led us to? You have an effective tax rate and a marginal tax rate. I said it's okay to start with the effective tax rate, even though it might be 12 or 15%. But over time, that tax rate should move towards the marginal tax rate. Why? Because you can't defer taxes forever. Now, let's get to that net capex line item. Remember, capital expenditures minus depreciation. Before we talk about the mechanics of what should go into it, let's lay a ground rule. If you ask me how much net capex should I be having for my firm, how much should I have in that line item? I'm going to ask you a question. What kind of growth rate are you using for your company? Why does it matter? If you have a high expected growth for your company, I would expect to see much higher net capex. Everybody agree with that? If you have lower growth, you can get away with low net capex. If you have no growth, maybe you have no net capex. Net capex assumptions and growth assumptions have to be linked at the hip. The most dangerous thing you can do in valuation is sit there and play with your growth rate and leave your net capex as is. I've seen bankers do it over and over again with predictable results.
Question.
Yes, go ahead.
What about a software company that basically doesn't necessarily need, like, how does that also apply for net capex growing for, say, a cybersecurity?
What's the biggest capex for a software company?
Probably
if you capitalize R&D, guess what? Software companies reinvest a lot as well. It's only if you trust accounting measures of capex that it looks like they can grow without reinvesting. And Uber looks like it has no capex, but when you bring in customer acquisition costs into capex, it's reinvesting a lot. This isn't a rule just for manufacturing companies. It's true for all businesses. The problem is accountants haven't caught up with us. So we have to do our own calculations to come up with what that reinvestment is. But I'll tell you why it's dangerous. If you sit with an Excel spreadsheet, you leave the net capex as a line item that's frozen, and you raise your growth rate from 6% to 8% to 10%. What does growth always do to your value? Increasing growth, holding net capex constant will always increase value. Because you've created a freebie, right? Growth comes at no cost. Of course, I'm going to grow faster. But when you raise the growth rate from 6 to 10%, I should be the skunk at the party saying, okay, that's nice, but how much more net capex will you need to sustain that growth? We need to have that discussion for this valuation to mean something. So when you think about net capex, think about your growth rate, and the net capex is to reflect. But I'm glad that question was asked about software companies, because if you use the accounting definition of net capex, you're going to go off, your numbers are going to be off what they truly are. The accounting definition of net capex, you go to the statement of cash flows. There's a capital expenditure line item under the investing activities. There's a depreciation line item in the operating item. If you trust those numbers, you get a net capex from the statement of cash flows. Let's start with it. That's the accounting net capex. But we've already talked about what's wrong with using that as your net capex. You're missing the fact that R&D is truly capex for pharmaceutical companies, that customer acquisition costs are capex for Uber. So my definition of net capex on top of the accounting net capex will include that additional net capex from capitalizing R&D, capitalizing customer acquisition costs. It's going to make a big difference for technology companies and pharmaceutical companies. But there's another item you miss when you think about net capex from an accounting perspective. Let's say you have a company that's in a hurry to grow. It wants to grow right away. It doesn't have the time to build a platform, acquire customers, do R&D. If you're in a hurry to grow, What's the pathway that companies adopt? They do acquisitions. Microsoft wanted to be in the metaverse and it wanted to do it quickly. So what did it do this year? Spend 70 billion plus buying Activision Blizzard. I'm not passing judgment yet, but when I compute the free cash flow to equity or the free cash flow to firm for Microsoft for 2021 or 2022, whichever year I put it in, I will show a huge net capex from acquisitions. Now, people often think if I have more in my net capex, I'm punishing the company. Not necessarily. I'm being realistic. I'm saying you spent a lot, but now when I forecast the growth for Microsoft, I might give them a higher growth rate because they bought Activision, but acquisitions should also be part of net capex. So let's see how much of a difference these adjustments make. I'm going to take a company that, it's been around a long time, but during the 1990s was the equivalent to what Tesla was in the last decade, a hugely successful company called Cisco. Cisco makes software for businesses, so most of you don't have a Cisco product at home, but a lot of businesses get their software from Cisco. Cisco started 1990 with a market cap in the single digits. I think it was 4 billion. There was a point in time in 1999, the middle of 99, where Cisco was the largest market cap company in the world. It lasted for like 25 minutes. Okay. When its market cap hit $450 billion. Now let's step back. You go from 4 billion to 450 billion. Did you have a good decade? Absolutely. But the way they did it was unusual. Usually software companies put in R&D to grow, right? Cisco actually spent they spent money on R&D, but it wasn't huge. They actually went out and did 12 to 15 acquisitions every year of small tech companies with promising products. And their claim to fame was, we can take this promising technology and make it commercially successful. They're the equivalent of SWAT teams that would land in a target company that acquired, and everything about the company be reoriented so they could get a product out. And they were very good at it. So if you're valuing Cisco, you can't treat acquisitions as something you ignore. They're central to the story. This is the way the company has succeeded, by doing acquisitions and converting those acquisitions to value. So this is a valuation I did of Cisco in 1999, peak of the dot-com boom, or close to it, when Cisco was the star company. So to get a sense of how much Cisco was reinvesting, I took a look at their acquisitions. And in 1999, they had 9 acquisitions they did during the course of the year. So there are the names of the companies they acquired. None of them are household names. And then you see in the second, it says pooling and purchase. You think, what is that? Thank God this is not something that US companies are allowed to do anymore. But pre-1999, US companies were allowed to account for acquisitions in one of 2 ways. If you paid with cash, or even partially with cash, you have to do what companies do today. It's called purchase accounting, which you acquire the company, you show its assets, and what you pay over and above the book value has to be shown as goodwill. That's the way accounting is done. So all the purchase accounting follows that practice. But US companies pre-1999, if they acquired a company and paid with shares, their own shares, were allowed to use what was called pooling. And when you did pooling, your acquisition completely disappeared from your books. There was no goodwill. You basically brought the 2 companies together. And for companies that hate to have goodwill on the balance sheet and have to amortize it, this was a godsend. But to do it, you had to buy the company with shares. Cisco bought 3 companies with shares, pooling. They were the biggest, including the biggest acquisition. But collectively during 1999, Cisco spent $2.5 billion. Notice when I count acquisitions, I'm not just counting cash acquisitions. I count share acquisitions as capex as well. You hear analysts say, but it's not a cash flow. Really?
Well, they could have bought
Yeah.
back the shares, right?
Or they could have sold the shares in the market, raised the cash and done the acquisition. You've skipped a step, right? This is exactly the reason I'm going to come back and talk about stock-based compensation as any other expense. Because there are analysts who say, it's not a cash expense. You cannot let companies use a barter system to evade cash flows. Otherwise, they'll be paying with stock for everything. They say no expenses. Does it make your revenues into income? So basically, all acquisitions are part of my capex, $2.5 billion. Just to give you a sense of what your numbers would have looked like if you trusted the accounting. Their net capex would have been 98 million. So if you looked at their statement of cash flows, they'd have capex of 584, depreciation of 486, that difference of 98 million. So if you trusted the accountants, you'd be telling the world they're reinvesting nothing, just 98 million. But if you capitalize R&D, that adds another 1.1 billion to the net capex. And if you bring in acquisitions, it pushes up the net capex to $3.7 billion. Again, it's not a good thing or a bad thing, but if you ask me, what did Cisco do in 1999? They reinvested a huge amount of money. Whether that's good for value or bad for value will depend on what I think about these investments. Will they make a high return in the future or low return? But my point is net capex from a valuation perspective is very different from net capex from a statement of cash flows. Any questions on net capex? Let's talk about working capital. Let's do a test of whether you remember your accounting. In an accounting class, when your accounting professor says working capital, how's working capital calculated? What's the definition of working capital?
Take the current assets and subtract them from the current liabilities.
I'm sorry. It's current assets minus current liabilities, right? That's the way I was taught working capital. That's the way we're all taught working capital in accounting classes. That is not the definition I want you to think about in valuation. One by one, I'm knocking out all the accounting things you've learned, which is a good thing, I think, in the long term. In valuation, what we call working capital is the difference between non-cash current assets and non-debt current liabilities. Let me explain why we do this. If you look at the current liabilities for any company, take a look at a balance sheet. You'll see accounts payable, supplier credit, deferred this, deferred that. And then you'll see short-term debt and short-term portion of long-term debt, right? It'll show up under current liabilities. Here's what I want you to do. Take that debt out of the current liabilities, treat it as debt when you do cost of capital. And if you treat it as debt when you do cost of capital, you can't also count it as part of working capital. So it's non-debt current liabilities. Now let's talk about non-cash current assets, because this is a little more controversial. You know why, if you're a retailer and your inventory goes up, why it's a drain on my cash flows? Why does having more inventory affect my cash flows if I'm a retailer or a store owner? What's the problem with having a lot of inventory? It's good, right? When a customer walks in, I always have what they need. But what's the downside of having a lot of inventory? While it sits on your shelves, it's making you no money, right? It's a wasting asset. More retailers have gone out of business because they don't know how to control inventory than any other single reason in the retailing business. So inventory is a wasting asset. As a retailer, if you sell items on credit, are you going to have more revenues? Absolutely. But when you sell items on credit and you don't charge interest, you can show revenues right now, but it's a cash flow drain, because until those people actually pay you, you don't get the cash flows. Inventory is a drain on cash flows. Increases in accounts receivable are a drain in cash flows. The question is having a cash balance a drain on cash flows? Is cash a wasting asset? What's the question I'm asking? You have $100 billion sitting in a cash balance as a company. Is it hurting your value, helping your value, or doing nothing for value? Anybody want to answer? Because I think it's a question that I see badly answered all the time. Because what's a surface answer? That 100 billion is sitting in a cash balance, you're a US company, what is it making right now? For something to be called a cash balance in a US company, what's it got to be invested in? Commercial paper or T-bills. Definitely not Bitcoin. Somebody should tell that guy who's put his money in Bitcoin, or Tesla did it. No. Commercial paper and T-bills. What do you think you're making on $100 billion invested in commercial paper and T-bills right now? You'd be lucky to be making 0.25%. Now, if you compare the 0.25% to your cost of equity or capital, what's your conclusion? This is a terrible investment, right? But think about it. You're investing in something liquid and riskless. What should I be comparing it to? In other words, the question I had to ask is, if I invested in something liquid and riskless right now, what would I make? I just got my online brokerage statement on, checked it out. And I looked at what I made on my cash holdings, and it made me cry. It's like 0.08%. But it's not that they're ripping me off. It's because the T-bill rate is 0.06%. They're not going to be able to deliver much more than that. The rate's gone up a little bit. That's why I'm making 0.08%. If your cash is invested in something earning a fair rate of return, guess what? T-bills and commercial paper, by definition, are earning a fair rate of return because that's the market rate. Cash is no longer a wasting asset. You're saying, when would I include cash in working capital? Maybe you run a business which requires that you have stacks of currency sitting around you. You know what kind of business? Maybe you're a drug dealer. Okay. Then I might include cash as part of working capital. So if a Colombian drug cartel calls you in and says, would you value our cartel? First thing I would do is say, please, no, thank you. But if you take on that mission, your cash balance can be part of working capital because there you are wasting cash. It's currency. I've actually made your life simpler because I said, look, there are these appraisal firms and consulting firms that take cash and break into operating cash and one of the biggest wastes of time I've ever seen. Because I don't care whether it's operating cash or non-operating cash. I care about, is it wasting cash or non-wasting cash? And the world we live in, the amount of wasting cash you have has become such a tiny percentage of the total cash balance that it's not even, there's no point to breaking down cash balances. Just take the entire cash balance out. So working capital is non-cash current assets minus non-debt current liabilities. So let's say you do this for your company, right? It should be easy enough to do. Go to your balance sheet, take all of the current liabilities other than a short-term debt and short-term portion of long-term debt, and all of the assets other than cash. You take the difference, and then you look at the change from the previous year. Here's the first thing you're going to notice. That number jumps around. One year it's minus $1 billion, next year it's plus $1 billion. Change in working capital is one of the most volatile items on balance sheets. And your job is to forecast it for the future. You're saying, what the heck am I going to do? Here's my suggestion. Don't take last year's change in non-cash working capital and build castles on top of it, because who knows what that number really captures. You have a question on Zoom, or is that your mic is on? I guess mic was on. Yeah. And in some companies, you're going to notice a phenomenon that's going to throw you off. You're going to have negative working capital. You see how you get negative working capital? If non-cash current liabilities exceed your non-cash current assets, your working capital is negative. And the reason it kind of throws people off is as you grow that, if you have negative working capital becomes a source of cash rather than a drain in cash. We think of working capital as something you put money in. If you have negative working capital, you could actually see yourself gaining from cash. I'll get into to see why you have negative working capital. I'll give you 3 companies, again, from way back in time. And I had to value all 3, so I needed to get a sense of what the change in working capital I should be using going forward is. So 3 companies are Amazon, Cisco, and Motorola. And this is Amazon, but it's a young online retailer, very young online. Its revenues were $1.64 billion. Its non-cash working capital was -$4 million.
Hey, Professor, sorry to bother. I think the mic just went out and I can't, it's very difficult. I think the mic just went out.
You're right. Thank you. Battery died, sorry. Okay, I think we should be back on now, right? Good. Yeah. Thank you for noticing that. Otherwise, I'd have spent the rest of the class with no mic. Yeah. So if you look at Amazon, working capital is negative. Now let's put some flesh on that number. How do you end up with negative working capital? Remember when Amazon was a young company, much of what it sold were books. It was an online book retailer. And here's what it would do. It'd go to a publisher and say, do you want to sell stuff online? It's the hardest thing. Everybody's buying stuff online. Publishers wanted to be on Amazon. So they would put their books into the Amazon inventory and they said, pay us in 60 days. So Amazon would get the books, agreeing to pay in 60 days. Then they'd proceed to sell the books to you and I. Now, when you bought the books, they didn't give you 60 days to pay. They said, pay now. So if you collect from your customers right away and you're paying your suppliers later, you're essentially using float to your advantage. Your cash flows are actually going to get higher because you're now using supplier credit as a way of funding growth. That's basically what a negative working capital is. And when you're a small company in a business that's growing, of course, I mean, in fact, this was one of the things people pointed to at Amazon when it was a young company, saying this is what's great about Amazon. Unlike traditional retailers where working capital drains your cash flows, here's a company that's turned working capital to its benefit. So when I valued Amazon, it's negative working capital as a percent of revenues, it's minus 25.5%. And it had been negative for as long as Amazon had been around. But it was in a sector where other companies, the traditional retailers, faced working capital requirements. So when I valued Amazon, the question I was faced with, do I leave it at a negative number and assume they can keep doing this forever? Or over time, do I have to become more realistic and say they will at some point in time have to invest money in working capital? I made a judgment call. I assumed that at some point in time, Amazon would have to shift away from this policy of paying people late and collecting money now, especially as it got larger, and that its working capital would converge on 3% of revenues, well below the average for traditional retailers. You know why online retailers will tend to have lower inventory than traditional retailers?
It's like an incentivized, they're like buy now, like they're running out of
But everybody has that incentive, right? Have you walked into a bookstore? I know it's tougher and tougher to find one still in the city, right? You walk into a bookstore, notice there are large sections of the bookstore where nobody seems to go. Like that philosophy section. What the heck are you doing maintaining a philosophy section? History section, full of dusty books that nobody's touched in like 5 years. Why do you have it? Because if you're a bookstore, you're supposed to have a philosophy section and a history section because you're supposed to carry a whole range of books. But if you're an online book retailer, and if everybody's ordering Harry Potter, guess what you have as inventory of? Hundreds of books, thousands of books of Harry Potter. If I want a philosophy book, you say, look, I'll get some guy to write it for you and send it to you in 6 weeks. Because as an online retailer, you can focus on the things people actually buy rather than on things that you have to show people. So basically, in steady state, I think online retailers will have lower working capital requirements than brick and mortar retailers because they don't need to have all their shelves filled out. I mean, imagine going into Target and there are entire sections where there are nothing on the shelves. Even if you didn't plan to shop in that section, it's kind of off-putting, right? So that's my rationale for working capital being lower in the long term. For Cisco, their working capital was also negative as a percent of revenues, minus 3.3%, but within a sector where everybody else also had negative working capital. So you know what I did? I left the working capital as a negative number. And my terminal value, because I don't want to keep it at a negative number, I made it 0, but I would have left it at 0, at a negative number forever if I needed to. So if you're a company with negative working capital in a sector where everybody has negative working capital, just a business which doesn't, where actually working capital works in your favor, pushes up your cash flows. And finally, a Motorola, more traditional company, working capital of 8.23% of revenues. As I said, working capital tends to jump around. So one of the things I look at is what was it 2 years ago, 3 years ago, just to make sure last year was not an unusual number. The 3-year average was 8.91%. The average for the industry was about 7%. All the numbers were kind of crunched together. Here I was okay leaving last year's working capital as a percent of revenues for my forecast. 3 companies, 3 very different judgments. But what I'm trying to say is don't make it a number, make it part of your story. If your company has tightened up credit requirements or there's less inventory, you can have a lower working capital requirement going forward because that's what it plans to do in the future. So you got after-tax operating income, you got net capex, you got change in working capital, you get free cash flow to the firm. Now let's assume though, at some point in time, you decide that you don't want to look at cash flows to the firm, you want to focus on free cash flow to equity. Now, if you're lazy and you want a free cash flow to equity, of course, you latch on to dividends. That's actually the only cash flow you see. And the traditional dividend discount model does exactly that. It focuses on dividends. But we know beyond any doubt that companies don't always pay out what they can afford to in dividends. Some companies hold back cash. That's how they end up with big cash balances. Some companies pay out more than they can afford. Why? Because they're caught in this rut of, hey, this is the dividend we've always paid. Put simply, dividend discount models can give you very misleading estimates of value of equity in companies where the dividends are very different from what these companies could have paid out. So if you decide to go the equity route, you have no choice but to ask and answer a question. What could this company have paid out in dividends last year? What can this company pay out in dividends in the future, rather than look at what the company actually pays out? I gave you the extreme example of a company like Apple, $93 billion in free cash flows to equity last year. Dividends were, and buybacks put together, were about 50 billion. Big number, but nowhere near the free cash flow to equity. When I value Apple, I think the more realistic number to focus on is not what they actually paid out, but what they could have paid out. So let's lay the groundwork for computing that potential dividend. Let's first talk about what you cannot do. I've seen analysts actually discount earnings back as cash flows using this logic, that companies can, if they choose to, pay their entire earnings out as dividends. That's true, right? If a company wanted to, it can pay its entire earnings out as dividends. But here's the catch. If you decide to go that route of paying your entire earnings out as dividends, what's the only growth rate you can use that's consistent with that assumption? Company pays out all of its earnings as dividends. What kind of growth rate will it have? You're putting nothing back into the business, right? Nothing's getting reinvested. At least in the long term, you might have short-term growth, but in the long term, your growth has to converge on zero. So if you insist on treating earnings as cash flows, you're paying it out, don't give me a 10% growth rate for the next 10 years, because those two numbers are internally inconsistent. So if you decide you want to put growth in your company, most of you want to put in growth, you cannot use earnings as potential dividends. What do you have to do? You have to take the earnings and figure out how much of those earnings will have to get reinvested to get whatever growth rate you're projecting for your company. So let's look at the calculation of free cash flow to equity. And I want you to focus on what's different about the free cash flow to equity calculation as opposed to the free cash flow of the firm. Do you remember what I started with the free cash flow of the firm? I start with the operating income net of taxes, right? When I start free cash flow to equity, I start with net income. Think of why. Free cash flow to equity is after debt payments. Net income is after interest expenses. Start with a different measure of earnings. The next two line items are exactly what you saw in the free cash flow of the firm. Net capex, change in working capital. Everything I said about those two items in the context of free cash flow of the firm apply to equity as well. And there's a new item that pops up here when you do free cash flow to equity that you did not see with free cash flow of the firm. Let's say you own a business. You decide to borrow money. And let's say the bank okays the loan. The minute after the loan is okay, what do you get? You get a cash inflow from the loan coming to the company. Every time you borrow money, cash comes into the company. Every time you repay a borrowing, cash leaves the company. From a cash flow perspective, then, the last line item captures the effect of new debt coming in. That's a cash inflow, and debt being repaid. So I start with a different measure of earnings. I subtract out net capex and change in working capital, just like I do in free cash flow of the firm. And then I have this new line item of how much debt am I taking on? How much debt am I repaying? Now, if you ask me to compute this for last year, it's easy enough, right? You go to the statement of cash flows, it tells you how much debt was repaid and how much debt was taken on. But let's say you've got to project this for the next 10 years. It's going to be a nightmare figuring out how much debt you repay, how much debt you take on. You often have to do that if you do a leverage buyout. You know, in a leverage buyout, you take this huge amount of debt and then you got to pay it down. But in most of the cases, you're sitting there saying, I don't know how much debt I'm going to repay. I don't know how much debt I'm going to take on. So I'm going to give you a shortcut, and then I'm going to give you a caveat as to when the shortcut is going to work. Because be careful and don't apply it across companies. Here's the shortcut. To get to free cash flow equity for a firm, start with net income. Look at net capex and change in working capital just like you did before. But instead of trying to figure out how much debt you're going to take and how much debt you're going to repay, tell me what percentage of your net capex and change in working capital is going to come from debt. Let me repeat that again. Tell me what percentage of your because net capex and change in working capital is what you reinvest. Tell me what percentage is going to come from debt. Let's say you tell me it's 20%. When I compute a free cash flow to equity, I'm going to start with the net income. I'm going to take 80% of my net capex and 80% of my change in working capital. In other words, I look at only what I have to invest as an equity investor, and I come up with free cash flow to equity. But to do this, I have to be willing to assume that that 20% debt ratio is known and that you're going to stick with this going forward. Many companies have target debt ratios, so this is not an unreasonable assumption. So if you tell me your target debt ratio is 30%, I might say, look, from this day on, 30% of what you reinvest comes from debt, 70% from equity. But this is a very selfish way of thinking about cash flows. You think about yourself as an equity investor. Basically, say, I don't care where the rest of the money goes or comes. This is all about me as the equity investor. What's my measure of earnings, net income? How much of my net capex comes from me? And how much of the change in working capital comes from me? And what's left is the free cash flow equity. Start of every year, I kind of get the data. I look at publicly traded companies. If you have, I don't know how many of you had a chance to read my data post update on earnings, but after the quiz, don't do it right now. You have other things on your plate. If you haven't read it yet, take a look at it, because it's an interesting story there about how earnings at companies have come back in 2021 relative to what happened after COVID, and which sectors are profitable, which sectors are not, which businesses are good and which businesses are bad. But as part of that process, I also compute the free cash flow equity for every company and compare to the dividends and buybacks of the company. In other words, I look at what are companies returning to their investors. You want to see what those numbers look like in 2021? To do this, basically the free cash flow equity, I'm going to use, you can use the shortcut that I just defined, or you can look at the total calculation. Here's what the world looked like in 2021. There's the free cash flow equity broken down by region of the world. So let's pick a region. Let's pick the US. The free cash flow equity, the US was $290.4 billion. So that's potential dividend, right? That's what they could have returned. See this second to last column? That's what was actually returned, $1.2 trillion. In 2021, at least, US companies returned significantly more in dividends and buybacks than they had available to pay out. Which means if I use a dividend discount model to value companies, including buybacks, I might actually overvalue companies because I'm looking at a cash flow that is not sustainable. In fact, every part of the world, this turned out to be true, except for, I think, India, where the free cash flow, in every other part of the world, they were actually in parts of the world where the free cash flow equity was negative, but companies continued to pay out dividends, continued to buy back stock. It's kind of a sobering table. It tells you, look, if you're trusting dividends, those dividends might have nothing to do with what a company can actually pay out. You might be building a castle on top of something that's not sustainable. So I'm going to take one company, take you through a free cash flow equity calculation using that shortcut with the debt ratio. And then I'm going to play a few games with that free cash flow equity calculation because I want to get a sense of what happens to a company when it borrows more money from an equity perspective. So, well, they're borrowing. So basically, at the end, I have a free cash flow equity. They can pay dividends with it. They can pay, do buybacks with it. They can do whatever. But I want to just see how did they come up with the free cash flow equity from which they're going to do all this other stuff. So this was in 1997. Disney had net income of $1.533 billion. Long time ago. Different company, different kind of business model. $1.533 billion net income. Their capex was $1.746 billion. The depreciation was $1,130. So basically, the net capex, if you look at the difference, was $612 million. Everybody see whether? So basically, it's the difference between the 1746 and the 1134. The change in working capital was $477 million. So basically, they invested $612 million net capex, $477 million in working capital. And here's where I'm going to slip in that assumption that I need to use the shortcut. In 97, Disney had a debt ratio of about 24%. They were pretty comfortable with that debt ratio. In fact, it was 23.8% if you want to get precise. Let's assume they're going to maintain this debt ratio going forward. They don't have to, but let's say they do. So what does that mean? Every year, equity investors will have to come up with 76% of the net capex and 76% of the change in working capital. And then whatever's left over, they can pay out as dividends or buyback stock. So let's see what the number would have been with the 24% debt ratio. Net income is 1,533 million. Net capex 612 times 1 minus the debt ratio gives me 466 million. So 466 million is what equity investors will have to invest in net capex. I take the 477 million change in working capital times 1 minus the debt ratio is 363 million. So basically, I'm subtracting out just the equity portion of the reinvestment from my net income. And what I end up with is a free cash flow to equity of 704 million. Let me pause right there. This is potential dividend. Disney can return that 704 million. What they actually paid out was 345 million. They had no buybacks that year. If you used a dividend discount model to value Disney, you're going to undervalue the company. Do you see why? Because you're focusing on 345 million when in fact you could have got the remaining cash. Remember, builds up in the company, you're just missing that cash. But I want you to focus on that 704 million. It's a function of the net income. It's a function of the reinvestment, but it's also a function of how much of my reinvestment comes from debt. You ready for the question? I used about 24% debt, 76% equity. Take a look at that calculation and tell me what will happen to the free cash flow to equity if I chose to use more debt. Let's say I decide to use 50% debt, 50% equity instead of 24% debt, 76% equity. What's going to happen to my free cash flow to equity? Is it going to get higher or lower as I increase my debt ratio? It's going to go up. In fact, as I raise more and more money from debt, I have to come up with less and less from equity, right? It's one of the great freebies in valuation. As you raise debt ratios, your free cash flow to equity is just going to get higher and higher because you're paying for less of the reinvestment. So your free cash flow to equity, as you go from 0% debt to 90% debt, rises. Now, what's the value of equity? It's the present value of free cash flow to equity, right? So this seems to suggest that as companies borrow more money, their equity value should always go up. That can't be right. What am I missing? Yeah. I'm saying, what if? I'm sorry, what was your question? No, but as long as it's given and it's constant, I can use any debt ratio. It doesn't have to be that it cannot change from the past. It's whatever you give me as a debt ratio, you're going to stick with for the next 5 years, the next 10 years. Well, so let's say I'm Disney and I'm telling you, I plan to use 40% or 60%. How will you know that they're increasing debt ratio? You can look at trend lines. Maybe they've gone from 6% debt to 25% debt over the last 5 years. And you're saying, hey, they seem to be increasing the debt ratio. It could be from looking at industry averages. Maybe everybody else in the sector is using 50%. But like everything else in valuation, you pass judgment based on what you can see happening at the company and what you see happening in the sector. But so let's say whatever the reason so as the debt ratio goes up, so what am I missing when I look at cash flow to equity? Yeah. In fact, what's the discount rate I should be using if I'm discounting free cash flow to equity? Cost of equity. What are the drivers of the cost of equity? You got a risk-free rate, which you can't affect. You got an equity risk premium, which you can't affect. And you need a beta. And what do we say about betas? You start with the business you're in, and then you look at how much debt you have. The beta we use to get a cost of equity is a levered beta. You see the other shoe waiting to drop? As I borrow more money, my free cash flow to equity goes up. But guess what happens to my beta as well? It goes up as well. I have a higher cost of equity and a higher free cash flow to equity. So I have a final question. You have higher cash flows and higher discount rate. Which one's going to dominate? And I'll give you the choices. It could be that increasing leverage increases value because the cash flow effects dominate the discount rate effects. It could be that increasing leverage decreases value because the discount rate effect offsets is greater than the cash flow effect. Or it could be magical, whereas I change my debt ratio, the two effects exactly offset each other. My value of equity doesn't change. That's a magical, right? But in corporate finance, there is actually one of corporate finance's most famous theorems says exactly that. It's called the Miller-Modigliani theorem, and it says it doesn't matter how much you borrow. And one way to think about the Miller-Modigliani theorem is if you lived in a Miller-Modigliani world, whatever you gain by borrowing more money in terms of higher cash flows will be exactly offset in your risk. And the reason for that is the Miller-Modigliani theorem is built on two assumptions. One is there are no taxes, so there's no special advantage to debt. And the second is No company ever goes bankrupt. Now, I don't know what world you live in, but that's not the world I live in. Now, April 15th is coming up. I wish I lived in a world with no taxes. But if I sent, I can imagine sending the IRS, I believe in the Miller-Modigliani theorem, therefore I'm refusing to pay my taxes. I don't think that's going to stand up in court. I live in a world with taxes and default risk, which means that there are cash flow effects and discount rate effects, and they don't always offset each other. In fact, they're almost guaranteed not to offset each other. Now, if you ask me which effect is going to dominate, you can see why the answer is going to vary depending on the company. With Apple, my guess is the next $50 billion they borrow on debt will create more benefits than costs. Why? Because they have the capacity to borrow a lot more money. But if you're a company that's already overly levered, wind resorts, you're already at 70% debt. That extra debt, the effect it's going to have on your discount rate is going to vastly exceed whatever benefits you get in your cash flows. Like everything else in corporate finance, we talk about trade-offs. And this is one way to think about the trade-off is that think about the cash flow benefits you get when you borrow more money. Think about the discount rate effects. The net effect is what's going to drive whether your equity is going to go up or down in value. And that's something worth latching on to. But there's no one rule that's going to apply across all companies. Any questions about free cash flows equity and how it plays out the value of equity? I want you to heave a sigh of relief at this page, because everything after this page is not on your quiz. That's small consolation. Everything up till now is on the quiz because cash flows. Yeah.
Wait, wouldn't you just want to like use a metric that doesn't like enterprise value or something where it doesn't take it? Like,
It's the same. It does. That's not true. That's in fact, people say that's why they use enterprise value, but it's definitely not true because the cost of capital will change as your debt ratio changes. Oh, so anytime your cost of capital changes, your enterprise value is affected by your leverage. So if you're using enterprise value because you think somehow it's independent of how much debt the company has, let that go. That's not a good reason. Now, we'll talk about when you use enterprise value, but this isn't even one of the top 10 reasons. There are reasons for using EV multiples. Maybe it's comparable across companies because of different depreciation methods, but leverage is always underlying your value. You can't ignore leverage. So let's talk about growth. Yeah, go ahead. Your question. Yeah. Then you'd have to do each year's debt repayment, debt paid, do the free cash flow equity, do the full calculation each year with maybe a changing beta, because if your debt ratio is changing, remember your levered beta will change from year to year. So you have to do the full free cash flow equity calculation each year with debt repayments and debt repaid. And then you have to do the cost of equity for that year based on the debt ratio for that year, and you need to do it over time. And then when you take the present value, the value is higher, debt worked in your benefit. If the value is lower, that didn't work for you. Yeah. I think that's good. I mean, the cost of capital is changing. Is it because you are over? I mean, the only reason the cost of capital changes is you're not at your optimal mix, right? So this is just a different way of answering the question. So when you talk about equity, we never talk about cost of capital because that's not. But if you're looking at the firm, the way debt shows up is only in the cost of capital because your cash flows are pre-debt cash flows. So if your cost of capital will decrease after you take debt, it's going to help you. If your cost of capital will increase, it's going to hurt you. So it becomes an even simpler test of will your cost of capital go up or down when you take on additional debt. So now let's leave the safety of cash flows. Safety in the sense, you always have an excuse when you do cash flows. It's in the, I mean, I'm just taking the numbers for the company, right? And let's talk about growth. If you sit down to value a company, which many of you I hope are starting to think about, what's the first thing you're going to check? When you think about getting a growth rate for your company, where's the most natural place to start looking to get a sense of what growth rate to use in the future? Look backwards, right? You want to see how quickly did this company grow last year? I'm not saying it's going to be the growth rate for the future, but it's natural when you think about growth to think about what did my company grow at last year? What did it grow at? We'll see that historical growth, which is what we call it, is not always a good predictor of future growth, but it's human nature to say, what was the growth rate like in the past? And to understand why we're doing this, I want to lay the foundations of how to think about growth. We're marketed this notion that growth is good, that more growth is better than less growth. And I want to let that go. Because growth is a mixed blessing. The good side of growth is it makes your revenues and earnings bigger in the future. The bad side of growth is what you have to reinvest to get that growth. And already you can see the net effect of growth can be positive for some companies, neutral for other companies, and negative for still more. And that's why the post, if you look at the post yesterday, I look across companies, the 45,000 publicly traded companies listed around the world, 57% of them in 2021 earned less than their cost of capital, which is a short end of saying they were destroying value as they grew. Doesn't mean they're bad companies. Maybe it was just a bad year. But a lot of companies out there destroy value as they grow. Yeah.
But isn't that more of a problem of like not finance, but like misaligned incentives and like this?
It doesn't matter. No, wait. It doesn't matter what the reason was. The bottom line is they are not great. So we can talk about why that happens and why some companies continue to stay in bad business. There are lots of reasons it happens. It could be the fact that its managers are investing other people's money. It could be a family group companies that are hold on to businesses because of prestige. They don't want to leave. Lots of different reasons. But the bottom line is there are a lot of companies out there that grow and destroy value. And it's good to put that on the table because that will make you more realistic in the way you think about growth. So if you think about estimating growth, the most logical place to start is look at the past. The last year, last 2 years. And of course, you have to decide what you want to look at. You want to look at revenues, you want to look at net income, operating. You can see that the numbers are going to be very different. I'm going to start with that. The second place to look, especially if this is the first time you're valuing a company or close to the first time, is you tell yourself, look, I'm not an expert in valuation. There must be other people there who know more about my company than I do. Why don't I use their estimates of growth? And there are two groups of people that people look to. One is managers, right? Because you assume managers of a company know more than you do. So when managers say we'll grow at 20%, your reaction is, who am I to disagree with this guy? He's been running the company. And the other group that you tend to look at, even though you say you don't, is if you pick a company like Coca-Cola or Facebook, you have 50 equity research analysts tracking the company, and each of them estimates a growth in earnings for your company. And you're saying, look, these guys spend all of their day, and they've been doing it for the last 7 years, tracking these companies. They must know something that I don't. Remember those 7 words. So when you come up with a growth that's very different from the analyst estimate, you know what you try to do? You try to push towards the analyst estimate, saying they must be right. So the second thing you do is you outsource the estimate. You let somebody else tell. And there's a third way of thinking about growth. I don't have the power to go around endowing companies with high growth just because I feel like it, and you don't either. Growth has to be earned. Ultimately, when you look at how companies grow, it comes from doing 2 things: reinvesting money back in the business and reinvesting that money well. So if we can somehow figure out how much companies are reinvesting and how well they're reinvesting, we're well on our pathway to estimating growth. It's called a fundamental or an intrinsic growth rate. Historical growth, outsider estimates of growth, fundamental growth. Let's look at all 3. Let's start with historical growth. You pull up Yahoo Finance, you pull up any or S&P Capital IQ, they usually report a growth rate over the last 5 years, the last 10 years, and it looks like a fact. But I'm going to start by arguing that when you look at historical growth, the number you arrive at can be very different depending on how you calculate it and what metric you focus on. So when you look at the growth in earnings for the last 5 years, you can compute an arithmetic average growth rate. You know what that is? You take the growth rate each year, you add up the 5 years, you divide by 5. Or you can look at a geometric growth rate. You think, how different can they be? You're going to be shocked at how divergent those 2 numbers can be. It depends also on the period you use. What was your starting year? What was your ending year? You start with a bad year, you're going to get a much higher growth rate. Anytime you estimated growth of 2009 as your base year, which was a terrible year in earnings. So if you want to have a high growth rate for your company, my suggestion is use 2020 earnings as your base year. The number will be low, you get a high growth rate. I'm not trying to teach you tricky things, but you're going to learn these things as you go along. So you want a high growth rate for your company, pick a base year that's low. It'll also depend on what metric you're focusing on. Whether you're focusing on growth in revenues, growth in EBITDA, growth in EBIT, growth in net income, growth in earnings per share. Very different numbers, but in very predictable ways. And finally, when you think about using historical growth, a couple of things you want to factor in. One is there's a mechanical problem you're going to face in estimating growth in earnings if your company goes from negative earnings to positive earnings. How are we taught to estimate growth rate? Take the earnings this year, divide by earnings last year, and you get a growth rate, right? Try that when you have negative to positive, and the whole thing is going to break down. Yeah.
Well, like unit economics and like subscriber growth instead.
You could do growth in users, growth in subscribers, growth. I mean, that's why there is no one growth rate, right? Depends on the metric you focus on, depends on the time period. So I'm going to show you growth rate estimates, again, from an old calculation, but you can see the differences across different metrics. This was a Motorola. This is start of the century. I have revenues for 5 years, EBITDA for 5 years, EBIT for 5 years. In fact, in the actual calculation, I had net income for 5 years and earnings per share for 5 years. First, I have the growth rates computed by year, right? So earnings to just the change in earnings. I have an arithmetic average by taking the average of the 5 years. I also have a geometric average. How do you compute the geometric average? You take the ending number and the starting number. You don't need any of the middle numbers, and say over the 5-year period, on average, how much did this rate? It's in fact in many services it's called CAGR, compounded annual growth rate. So if you see that, it's a geometric average. You're saying, what's the big deal? On revenues, not such a big deal, right? Arithmetic average and geometric average are pretty close. As you go to EBITDA, the difference starts to widen. As you go to EBIT, it gets even wider. When you get to net income, it becomes a chasm. So let me ask you a question. Why, as you go from revenues to EBITDA to EBIT to net income to earnings per share, is the difference between geometric averages and arithmetic averages getting wider? Yeah. In other words, the earnings are more volatile than revenues, and net income is more. In fact, there's the clue right there. The only condition under which arithmetic and geometric averages are going to be exactly the same is when the standard deviation is 0. When think about it, if my growth rate is 8% in year 1, 8% in year 2, 8% in year 3, 8% in year 4, 8% in year 5, my arithmetic average is obviously 8, and my geometric average will also be 8. The more volatility there is in a number, the greater the divergence there will be between arithmetic and geometric averages. It's a statistical artifact. It's got nothing to do with finance. So when an analyst tells you the growth is 17%, before you believe him or her, you know what questions you need to ask, right? In what metric? Is it earnings per share? Is it net income? And if it's an earnings per share, you say, what's the growth rate in revenues? If you're getting a 20% growth in earnings per share, but your revenue growth rate is 3%, I'm not saying you discount the growth in earnings per share, but you get a little more suspicious, right? Because there's something that cannot be sustained. So don't take growth rates as given. Think about what the metric is and why and how the growth rate is computed. I talked about how when you have negative earnings going to positive earnings, it can create a little bit of a headache. So let me make this a very simple example. This is from 97. Time Warner had earnings per share of -5 cents in 96, and that earnings per share went to 25 cents in 97. Let me stop right there before you compute growth rates. Is it a good thing or a bad thing to go from -5 cents to +25 cents? It's a good thing, right? So you went from negative to positive. If you compute a growth rate using all the equations we're taught, you know what you're going to do? You can take the earnings per share this year, 25 cents, divided by earnings per share last year, which is -5 cents. You subtract out 1. The growth rate you get is actually -600%. It's absurd. I'm going from -5 cents to +25 cents. Clearly, my growth rate is not -600%. So when you see that, what's your first reaction? The minus is a problem. Draw a line across, it becomes plus, the problem goes away. Mathematically, you know how you justify it? Instead of using the actual earnings, use the absolute value of earnings, all of a sudden magical things start to happen. This is something that computers sometimes miss, right? Because you put this, let's say you have 2,000 firms in your sample. You're computing the growth rate for every one of them by taking the most recent year's earnings and dividing by last year's earnings. If you don't put an if statement in there to check that the earnings last year are positive, you can get some really strange looking numbers pop up because this is exactly what's happening in the background. So when people have negative earnings going to positive earnings, they play all kinds of games. One thing they try is they use the absolute value. Another is they use the higher of the two values, right? The 25 cents, if you put that in the denominator, you're not supposed to do it, but at least the number makes more sense. Here's the bottom line. When you go from negative to positive, you ask me what's the growth rate? My question is, who cares? Because ultimately, why do we compute growth rates? To project out the future. None of these growth rates make any sense for projecting the future. So when you're going from negative to positive, your company, just ignore the historical growth rate because you could play games for the next 2 weeks, come up with a number, but it's completely useless. Yeah, because which one are you going to use for your projections? None of them really make sense, right? This is a scenario where I think it actually makes far more sense to go to revenues. Think about revenue growth rates, because revenue growth rates won't do these weird things year to year. You're not going to get negative revenues, right? So revenue growth rates, in my view, are much more honest depictions of growth than most companies. But analysts still focus on earnings per share growth, which can give you very strange numbers for these same companies.
Right, but if you do it more than 1 year, like, shouldn't it, like, if you take your geometric average?
Well, what if you have a cyclical company that has negative to positive to negative to, this is not,
take a geometric average, it'll be fine, right?
it doesn't matter, right? If your starting year is a negative number, you still have the same problem. If your geometric average is positive numbers, bracketing it, you're okay.
Oh, right.
But if you're,
So just choose a base, that's fine.
you can, but I'm saying it's a problem that, see, if you look at the numbers, you have fixes, right? But if you're doing this for 2,000 companies, I'm saying be careful about how you set up that equation and copy it down, because you're going to run into this problem with at least 100 of those companies. Trust me, this comes from hard experience, because when I first computed growth rates, I would take that equation and copy it down. And only when I started looking at the distribution, that number doesn't make sense, and took a look at the number, that I realized that I wasn't correcting for this negative deposit. No. Because Capital IQ will not, basically Capital IQ will you download an Excel spreadsheet. You have to build your own protection.
Oh, you
when you
can't
do.
download one that concludes.
No. They do have a compounded annual growth rate, but take it with a grain of salt, because God only knows what went into that black box. So let's talk about growth rates in the past. Go to Callaway Golf. You know what their big breakthrough product was? A golf club called the Big Bertha, the early 90s, hugely successful product. Don't ask me, I don't play golf. I have no idea why people pay hundreds of dollars for a golf club, but presumably it takes bad golf players and makes them into good golf players.
It's just like basketball.
So this is actually Callaway Golf at the peak of its success. So I was valuing Callaway Golf in 1996. Here's what the net profit looked like over the previous 5 years. Now let's start with the easy part. Did they have a good? Absolutely, they had a great 5 years. In fact, over these 5 years, their compounded annual growth rate, so I'm not even playing games with the growth rate, was 102% a year. That's kind of a fact, right? They grew fast. Let's say I'm one of those lazy analysts who decides I'm going to use past growth rate as my predictor for future growth. I put in 102% growth rate for the next 5 years. Take a look at what happens to my earnings. 122 million becomes 4.1 billion. It's easy when you're doing valuation to forget the compounding effect on growth. You put in a 20% growth in your revenues, you say, what's the big deal? It's 20%. Take a look at what happens to your revenues over time, because it might freak you out. Because you might be taking a company with 10 billion in revenues and making it 100 billion. You're saying, what's the problem with 100 billion? The entire market might be only 80 billion. So take a look at absolute numbers. And we have small companies, even if you trust the historical growth rate, be careful about using it as your projected growth rate, because you're now a much bigger company. Scaling up is hard to do. Is that the song? I think it's breaking up is hard to do, but maybe a song should be written, but scaling up is hard to do, because as companies grow, their growth rates will almost always decrease because they're now much bigger bases. I'm going to at least start with the analyst estimates. As I said, none of this is on the quiz, on the growth, none of the growth rate stuff is on the quiz. But for most of you, you should be able to find an expected growth in earnings for your company coming from analysts. In fact, if you have S&P Capital IQ, they have a consensus estimate for the next 5 years. As you look at this estimate, you think, no, this is all they do. Remember I said as sell-side analyst, you're given 15 companies for the rest of your life. You're going to track these 15 companies. You know a lot more about these companies than anybody else looking at this company. And much of the time you spend on these companies is not in valuing the companies. In fact, very few equity research analysts actually value companies, but they spend a lot of time projecting earnings per share and estimating what will be next quarter and the next year. So if this is all you do, you know a lot about these companies and you're spending all of it forecasting earnings, you must be better at forecasting growth than the average investor, right? So let's start with that question. What exactly do analysts bring into growth rates and how good is it as a predictor of future growth? I'll start with the bad news. If you look at analyst estimates of earnings growth and you compare it with just a time series model where you take a computer and project out earnings based in the past, analyst estimates must be much better than time series models, right? Because you have all this information, access to the company, research. Study after study, going back 25 years. Starts with finding that analyst estimates are better than time series models. That's a good news, but not by much. In fact, take a look at the difference. This is the forecast error. This is the kind of mistake you make. So the smaller the error, the better your estimate. It's true, analyst estimates are more precise than time series models, but the difference is amazingly small. Think of the tens of millions of dollars we spend paying equity research analysts to forecast earnings. And their growth rates are barely better than time series models, which raises an interesting question. Why isn't it much better? Why aren't analyst forecasts much better? I actually presented this to an equity research analyst conference. I don't think they're going to invite me back, but they had all kinds of excuses. They said, this is true across all analysts, but a lot of bad analysts, and none of them are in this room. They said, if you focus on the very best equity research analysts, you're going to find that their forecasts are better. And there's actually a group of equity research analysts who are given that status of being the very best analysts. They're called All America. It's like the football team. Called All Institutional Investor, going back 50 years, has identified, they picked 2 or 3 equity research analysts in each sector and called them All America analysts. And if you're a sell-side equity research analyst and this gets attached to your name, you're made for life. From that day on, this becomes part of your name. So you're Joe Brown, All America analyst. So it all runs together. Next session, when we start out, we're going to look at forecasts made by All America analysts, and something magical is going to happen to your forecast, and we're going to see why. So that's after the quiz. So come back after the quiz for the rest of the story. Hey, how are you?